Good evening, everyone. Today is Monday. It's the 23rd of July, 2012, and the market's closed here. This is the 1 minute chart of today's action. And what we see here is a red candle on the open, and we're looking at, again, these are 1 minute time frame. As the market got back above the volume weighted average price, this market really had what looked like a bullish day. But of course, when you back it up to the daily time frame, we were down just about 1% in the SPY. We do still have a pattern of higher highs and higher lows in here, and we kind of came right down to that trend line we've been observing and found some support in there. So when you look at it, we are below a declining 5-day moving average. So from an intermediate term standpoint, I think we still have to look at it as guilty till proven innocent, which means it's riskier to hold longs overnight. But you can't day trade against the direction of the volume weighted average price in the session that you're day trading, I believe, as well. So we still have the same kind of scenario that we had on Friday, which is a mixed, a market that's given us mixed messages. We had seen and observed last Friday that it was time to become more defensive because this pattern of higher highs and higher lows had been interrupted with that gap on Friday. We were thinking, speculating that let's see if it can find some support here at the 5-day moving average. But as I often say, we don't want to put our bids in at that 5-day moving average. We want to wait for evidence that the buyers have actually gained control. So hopefully you weren't buying on Friday afternoon thinking that, well, it's at the 5-day moving average and that's generally a place of support. It's oftentimes a place of support, but again, moving averages should be used as a reference point just to look for the evidence that the buyers are in fact gaining control. And what we had seen through Friday was that pattern was then the lower highs and the lower lows in here, so it didn't make sense to pay up for it. Now today we had obviously the buyers come back into the market during the day. I had tweeted earlier in the session I wouldn't be surprised to see this week if we test the 50-day moving average. That's just below us at 133.50. So today's low was down at 133.84. We were only 34 cents away from testing that 50-day moving average, and there's really nothing particularly important about that 50-day moving average other than it's something that a lot of people look at. And now we can see here that 50-day moving average is beginning to flatten out. I think the more important level that we want to see this market continue to hold above is down here all the way at about 132.65ish. So that is the lows from about a week and a half ago. We could still see that happen this week. Don't be lulled, I think, into a false sense of security just because we had a rally through the day. That's good for day trading, but the intermediate term trend has been damaged here and is going to need some time to heal before it can kind of resolve itself. If we take a look at let's take a look at some Fibonacci here. We can say from that low to the high last week we did go beyond that 61.8%. Now we're at the 50% retracement level of it. And if we look at the volume weighted average price since that low, the average participant since that low right there is still in a losing position with the volume weighted average price up at about 135.85. So real mixed messages here. We've got a lot of important earnings coming this week. I think this week is the biggest week for earnings releases, and it just tells us that in this economic uncertainty, there was more news from Europe this morning. That we still have, and in the middle of earnings season with all this news and outside stimulus, we have to be really vigilant about managing risk. We were talking about the 63 level for a while in the Qs, and 63 and a half, and those levels have kind of been I don't want to say that they're not as important anymore, but they've taken on maybe a little bit less significance as we kind of keep going back and forth above and below those. We had noted last week that the break of the trend line didn't ruin the budding recovery here at the flat 50-day moving average. That the more important level is down closer to 61.50. So going back to that 65-minute time frame. 61.50 I think is going to be the important level for this NASDAQ, and I wouldn't really be surprised to see it tested at some point this week. Now again, it was encouraging to see that we opened right near the lows and had a nice rally in there today, and we can see when the buyers took back control above that volume weighted average price, it never made a lower low, and made it all the way up exactly to daily S2 from that is came up from below here, and now we need to see if this market's going to settle down a little bit, maybe digest these earnings, and I would think and hope that we start to see a little less volatility in this market overall. The Russell 2000 broke that 78 level and stayed below it on a closing basis. In fact, we finished pretty much dead on that 50-day moving average, maybe about 10 cents above it. But this is a level that we've been watching for a while, and it's actually, the bigger band is still quite above, is 78 to about 78 and a half. So this prior band of support turned into a band of resistance and support again, and now we've got to kind of let this thing settle in a bit here. We closed the gap in this Russell 2000, and now as we said Friday, the best case is that this market is turning a little bit more neutral, and that it wouldn't be surprising to test the 50-day moving average. Well, now here we are. We're on that trend line that we were looking at as well, and now we've got the potential for bigger resistance. I think up near 78 and a half, even to 70. Last week's middle of last week's lows near about $78.80. So it's a big giant mess, but you back it up a little bit here again, and you look at another significant moving average, and that's the 200-day moving average. So we're down to that 200-day moving average, and perhaps this is the point where we start to see some of the volatility come out of this market, and we get a little bit more neutrality. It's still just, again, not to be a broken record, but it's a real mixed bag. And the semiconductors had continue to test this level here, which is a 61.8% retracement of the lows from October of last year to this year's highs. This is the third time we've been down here, and we continue to find some support in this general area. But the more time support is tested, the more likely it is to fail. If we make a new low below 29.50, then it appears to me that these semiconductors would be heading down for at least about the 28 and a quarter level. And what we saw in here was, again, that last week we were talking about it. If you look at the blog post I had made at alphatrends.net, that I thought there was a high likelihood that once again we would that this rally would fail to hold because we had the declining 50-day moving average. And when we have a declining 50-day moving average, you want to look at the market as guilty till proven innocent. It's got something that it needs to work out still. That is, the trend is still lower, and it takes time to heal the damage. At a minimum, they typically do not just turn all at once and head higher. A lot of people get excited and think that's going to happen, but that's not the way it typically happens in real life. The financials broke below that 1425 level we've been talking about, and now look like 14 is likely here, probably even this week. We're pretty close to it. But anyways, this 14 and a quarter to 1435 prior support in here, now looking like it has the potential to act as resistance. Even if we got up a little bit higher from here, we still have a declining 5-day moving average, which says the intermediate term trend is still lower. It's guilty till proven innocent, and this is looking similar to the Russell 2000 in that we're just on that 200-day moving average. So conflicting signals continues to be the main message that this market is telling us. The correct way to interpret that is that there's indecision in this market, and it's not a time to making big, heavy commitments to either the long or the short side. So hopefully you're doing okay in this environment, and listen to the message of the market.